Greeting, friends. Steve Ship here, coming to you from Laguna Beach, California. It is November 3rd, 2022, the day after the Federal Reserve made their comments, specifically Jay Powell, post-board meeting. A lot was said yesterday, and the commentary has dramatically moved markets. Yesterday, at one point, the futures were off 800 points for the Dow. Frankly, guys, the Federal Reserve should not have that much influence in the market, but they do, unfortunately. We seem to, in this downturn, be paying far more attention to what the Federal Reserve is doing than we have historically. Today, what I want to share with you is exactly where we're at and what the Federal Reserve had to say yesterday and how that is likely to affect us on a go-forward basis. So without further ado, let me share my screen. Here we go. Put together a quick PowerPoint presentation. Federal Reserve keeps getting it wrong. If you've seen some of my other stuff, what I've shared with you, and I'm going to go over briefly today, is the Federal Reserve is so bumbling their policy that they are dramatically and grossly affecting our economy in a very, very adverse way. They're taking a situation that was bad and making it far, far worse. And I hope to convince you of that, because I tell you what, this will be my fourth economic downturn, starting back in 1992, first out of college. And I will tell you that my belief is that I've never seen anything so mishandled in terms of government policy, or in this case, Federal Reserve policy. It starts with this. It's the biggest mistake and experiment in the history of the world, certainly in the history of the US. This is a chart of M1. M1 is the primary money supply associated with US currency. It's the money that's in your pocket. It's in your bank account, checking accounts, in your safe deposit box. You're safe at home. It's essentially the money in circulation. This going back to about 1960, there's been a steady increase in M1, the money in circulation, because that's what happens when you have a growing population and a growing number of businesses. You need more money in circulation. By the way, there's a direct correlation between money in circulation and inflation. And some will say it's a 1-to-1 ratio. I haven't researched enough to validate that, but there's definitely a correlation. Note this, in 2009, this is sort of towards the middle of the Great Financial Recession. Ben Bernanke, the then chairman of the Federal Reserve, also became known as Helicopter Ben Bernanke because he was very loose with his monetary policy. He grew the M1 from about $2 trillion, or just under $2 trillion, to about $4 trillion. But that was, guys, over a 10-year period. And look, we needed stimulation. The way the Federal Reserve and the government gets us out of an economic recession or depression is to stimulate the economy. And the way they do that is to get you and I to go spend money on goods and services. 70% of the GDP here in the US is consumer driven, which is a little backwards, frankly. The other thing the Federal Reserve has done, let me back up. I didn't cover this. This is the most important thing. In early 2020, as a result of the pandemic, the Federal Reserve started printing money and essentially giving it away through PPP and Fed stimulus. They also spent about $120 billion a month on both mortgage-backed securities and corporate debt, all with the intention of keeping our economy from collapsing. And certainly they did, but look, you have to acknowledge that they went way, way, way overboard. This is something that we've never seen here. Over about an 18-month period, the Federal Reserve increased M1 by over 500%. Ben Bernanke did 100%. They doubled the M1 over a 10-year period. Jay Powell, our Federal Reserve chairman, increased it by 500% over an 18-month period. That's $17 trillion of additional capital flowed into the U.S. economy, and it grossly distorted asset prices across the board. You can't put that much money in the hands of consumers and businesses without grossly overstimulating demand. Guys, it was never a supply shortage. There was here and there issues of supply chain disruption, largely because of China's zero COVID policy. But for the most part, it was never about a lack of supply. It was about an overstimulation of demand, such that we've never seen before. The way they also sort of put the cherry on top of this overstimulation of demand was by artificially reducing interest rates. And they did that through quantitative easing in the form of buying mortgage-backed securities. This chart right here is a 30-year fixed rate chart. It's the money that you would use to buy your home. Here in 2020, they started buying those mortgage-backed securities, and in doing so, driving interest rates down to artificially low levels. 2.5% for an interest rate is ludicrously low. It shouldn't exist. That's equivalent to, well, that's actually today less than the 10-year treasury. Sorry, but it makes no sense. But in doing so, what they did was, in conjunction with putting all the liquidity in the average buyer's pocket, they made buying homes and cars and other things very, very, very cheap. And that's what drove asset prices through the roof. The average increase or lift in price across the board, and it's just an average, is about 40%, whether it's single family homes, whether it's multifamily homes, whether it's industrial product, whether it's used cars, new cars, whatever, it's about 40%. All that has led to a gross increase in inflation. And there's other factors, obviously, that come into play as it relates to inflation. But this is, guys, all the Fed's doing. They did this, they did it intentionally, and they did it with really a lack of foresight. And we're seeing the consequences of this. So the Fed right now, as you know, is trying to crush inflation using a sledgehammer. And the sledgehammer is having huge adverse effects here in the US and, frankly, abroad. Including the massive decline in the value of single-family homes, multifamily homes, industrial property. Stock market is in a bear market and will continue to be in a bear market for quite some time. It's just the nature of what happens when the Federal Reserve is on an aggressive monetary tightening policy path. Excuse me. Let me just say this: if Jay Powell was head of a corporation, either public or private, he would be fired. His gross mismanagement has put us all collectively where we're at today. We're paying extraordinarily high prices across the board. And now we're starting to see the economy suffer in ways that should never have had to happen. It's just gross mismanagement. And I know that I'm overstating that. I'm stating it maybe too much, but that's my belief. So what happened when we printed all that money and we stimulated the economy through stimulus checks and PPP and other means by which we put money in the hands of consumers? Well, this is the personal savings rate. And it goes back to 1960 as well. You can see that here, boom, we created household wealth to a level that's never been seen before here on a relative basis in the history of the US. And what do we do as consumers with money when we have it? It doesn't just sit in our bank account. We spend it. And that spending also grossly contributed to inflation and the supply shortage. Again, it was not a lack of supply. It was overstimulation through excess demand. And unfortunately, what we're seeing today is now we went from an all-time high in terms of household wealth or savings, I should say, to an all-time low, at or close to an all-time low. And that's having an effect on the economy. We're struggling as consumers here in the US. The segment of the economy that's not struggling is the top 5%, maybe even the top 1%. The rest of the US economy and consumers and households are struggling. And here it's reflected. This is the University of Michigan Consumer Sentiment Report. It's a chart that goes back also just prior to, well, 1978. Consumer sentiment is incredibly important here in the US, simply because, as mentioned earlier, 70% of the gross domestic product, or our economy, is as a result of you and I spending money on goods and services. We're not feeling so good about the economy today, guys. We're at or close to an all-time low. And that bodes very, very poorly for the future of the US in terms the near-term future of the US in terms of recession. To me, it's inevitable. Frankly, to me, I think we're in a recession. First 2 quarters of 2020 were negative growth. That, by definition, historically has been what we call a recession. We argued, many of us, not me actually, but many people argued, including Jay Powell and our president, we argued that that's not really recession. Unemployment is too low. And there's an argument to be made that says that's right. But you know what? Let's not try and recalculate how we define a recession. We here in the third quarter saw some positive growth. Frankly, I think that's simply as a result of inflationary pressure. We didn't buy more. We just bought the same amount as we used to, but costs have gone up by more than 10%. That's going to put us over the line such that it looks like GDP is positive when frankly it's not. Um, Comments from J-Pal yesterday. Saying the war in Ukraine is causing tremendous human and economic hardship, obviously, and I deeply feel for those that are affected. Western Europe, particularly those in Ukraine. My heart and my blessings and my prayers go out to them literally every day. I can't imagine what that would be like. But let's not use that as an excuse to whitewash what the real cause of inflation here in the U.S. is, and that's the Fed policy over the last 24 months. So they went from feeding us drugs and candy constantly to causing us to be I don't know, cold turkey, I think is the name of it. So they went from massive abundance to stark reality, which is you get nothing and you'll like it, and that's painful. And they say they're highly attentive, I should say, to inflationary risk. Duh. We've never seen the Federal Reserve increase monetary policy or restrictive monetary policy through Fed fund rate increases nearly as aggressively as they have, and they've done so in the middle of what I think is a recession. That is not going to end well. By the way, let me just talk about this. This right here, this influx of liquidity, it's stimulated bubbles in pretty much every asset class, whether it's Bitcoin or single family homes, commercial real estate, the stock market, all-time highs in many, many ways. So instead of back as it happened back in 2008, that was a single bubble popping. That was single family homes. It popped. The bubble occurred, frankly, because of subprime mortgages. Anybody who wanted a mortgage could get that mortgage through what's known as a liar loan, whether you had the capacity to repay that loan or even keep it current or not. When you give that much money in the hands of virtually everybody, the asset class that they're pursuing, which in that case was single family homes, is going to blow up in price. And that's exactly what we saw then. But that was a single asset, guys. That was a single asset that's popped, that bubble burst, and it caused a huge financial recession, putting companies like Lehman Brothers and Bear Stearns effectively out of business, bankrupting certain countries. It was horrific. That was one bubble. Now we're talking about bubbles virtually in every asset class. As I mentioned earlier, single family homes, 40%. All of that's retracing, and we're probably going to lose all of that 40% and then some, simply because we tend to overcorrect when things get difficult. So more ludicrous commentary by the Federal Reserve. They're going to periodically, probably consistently, take into account the effect of tightening monetary policy. But the problem with that is, just as when you stimulate the economy, it doesn't show up overnight. When you destimulate the economy through reducing liquidity in the marketplace, quantitative tightening, and increasing interest rates, it takes a while for that stuff to show up as well. So he's on the warpath with a sledgehammer and expecting that he's going to have to maintain that quantitative tightening for an extended period of time to crush inflation, the very inflation that he created. Well, that could very well be, but he's not giving himself a chance or the economy a chance to react to these increases in rates. Had he become cognitive in advance of this massive inflationary bubble, he would have stopped quantitative easing earlier and started this policy of increasing interest rates, quantitative tightening, much, much earlier. But he allowed us to binge far too long, and we're suffering those consequences today. Yeah. Here's this in red here is, by the way, probably one of the most important things he said yesterday. So the Federal Reserve, through quantitative easing, and as I mentioned this earlier as it relates to interest rates, they will artificially reduce interest rates by buying mortgage-backed securities. There's a limited pool of these securities, and when you start gobbling them up to the tune of $30 billion a month, you are reducing that available pool, which drives yields down or interest rates down. The inverse also happens when you start to sell the securities that they currently have on their balance sheet. You are increasing the pool of those securities, which drives rates up. So thus far, they haven't sold a whole lot of treasuries. And interest rates, by the way, as you have seen, I'm sure you're grossly aware, have increased by almost 300% over the course of the last 6 months. That, as you can see, rarely happened in the history of the U.S. It only happened back here in the late 70s and early 80s as a result of the then chair Paul Volcker trying to crush inflation then, which was runaway inflation, that's for sure. So this is not him selling, the Federal Reserve selling mortgage-backed securities. This is just the market reacting to what's going on in the economy. And so when he starts to sell those mortgage-backed securities, you should expect interest rates to continue to increase. And that's going to have a really, really adverse effect on valuations across the board. Look, the Federal Reserve has multiple mandates. These are those mandates. And those mandates were sort of defined by the Congress Employment Act of 46 and the Employment and Balanced Growth Act of 1978. So first off, stability in the financial system. Let me ask you, is there any stability in our financial system? Well, it's about as unstable today as it has been in quite some time. Price stability, fighting inflation. I kind of look at these as two different concepts. Price stability certainly is out the door and has been for the last 24 months. Valuations have gone all over the place. They went through the roof and now they're retracing, whether it's the stock market. Price of lumber was up 600%. Now it's back to pre-pandemic levels. Used cars, way through the roof, up 40%, as I mentioned earlier now, and they're starting to retrace. And I'm sure that we're going to get back to at least where we were pre-pandemic level. And the same, by the way, is true for single-family homes, up 40% on average across the U.S. But the reality is we're likely to give all of that back and then some, which is just happens in a market correction during a financial recession. Full employment, yeah, we're beyond full employment today. Our unemployment level is the lowest it's been, I think, in 60 years since post World War II. Economic growth, guys, no. I think the answer is we're not in a growth pattern right now. The world is not in a growth pattern. We are preparing to enter in probably one of the worst economic recessions we'll see in our lifetime. And that's, again, because we're seeing all these bubbles bursting across the board. I shouldn't say bursting. Bubbles don't pop overnight, or they rarely do. Even during the Great Depression, the stock market took years before it found its bottom and started to recover. It's going to be likely years before we eliminate the excess liquidity and understand true values, whether it's stock market, Bitcoin, single family homes, commercial real estate, whatever. So economic growth, look, I don't think that's possible, not given the gross Fed policy today. Interest rate stability, obviously, no. When interest rates increase by 300% over less than a 6-month period, there is no stability there. Currency stability, yeah, and no. The only reason why the US dollar is so strong today is because on a relative basis, all other currencies are weak, and they're weak for a variety of reasons. The pound, the British pound is incredibly weak right now simply because of the previous prime minister's policy. That's recovering. The European Union and the euro is incredibly weak for a variety of reasons, including a very uncertain near-term future. We don't know what's going to happen in Western Europe, particularly countries like Germany that rely so heavily upon Russian inflow of natural gas. I think 80% or maybe even 90% of their energy is brought to them through Russia, and they're deeply reliant on it. And look, food uncertainty and the ability to deliver enough food product to Europe is also very much in question given the war in Ukraine. But look, the US dollar, despite our pumping massive amounts of liquidity into the marketplace, is strong only because other currencies are weak on a relative basis. The yuan, the yen, etc. The ultimate rate will be higher than previously expected. This is commentary directly from the Fed chairman, Jay Powell. And so my point there is just expect him to continue on his overly aggressive interest rate hikes, and also quantitative tightening in the form of selling mortgage-backed securities and other assets that he has on his balance sheets. He's just going to continue to make that happen. And that's going to have, again, combination of what he's doing is going to have a very adverse effect on the economy. That plus the disinflation of bubbles is going to cause a lot of pain here in the US. And I'm not sharing this to scare you. Frankly, I look at economic downturns as a chance for us to rebalance as an economy, but also to buy assets at generational lows. And I'm expecting that's going to happen. I know it's already starting to happen today in commercial real estate, which, as I mentioned earlier, is my bread and butter. It's my game. It's what I've done for 30 years. Okay, so on a side note, what we do at Performance Advisory Group is we invest in distressed commercial real estate of all types. We teach people how to invest in distressed commercial real estate. It's a program that I call Code to Generational Wealth. As a sidebar on that, more Americans, the vast majority of the wealthiest of Americans have made the preponderance of their wealth through investment in commercial real estate. It's like 80%. So it has been historically the single best investment over the last 100 years, outpacing the S&P by more than 700%. The tax benefits associated with commercial real estate are unparalleled in the asset class, at least that I'm aware of. And it's going on sale today at prices I haven't seen since 1992. It's also more available. Historically, commercial real estate has been the purview of the wealthy and Main Street. Or, either that, it's been owned through generations, and like here in Laguna Beach, most of the commercial real estate's owned by families that have owned it for decades and decades. But that's all changing. Today, we're seeing commercial real estate being liquidated at prices I haven't again seen since 1992. If you'd like to know more, email me. I'll leave my contact information at the end of this presentation, but email me and I'll give you links to masterclass, and I'll invite you to fill in an application to potentially enroll in one of our courses. So home prices are falling faster than any time in the last 40 years due to Fed policy. Equity markets are confused, and certainly they're uncertain. Over the last 10 days, the equity markets have been on a bear market rally. So they've been going up and up and up and up consistently until yesterday when the Fed spoke. Look, I don't know what investors are thinking today in the stock market. I'm not in, and I would definitely recommend to my family and friends that they shouldn't be in. We have a long way to the downside before we find a bottom. And I think that's probably a year or two, or maybe even 3 years out. But along the way, it does make sense to leverage in. You probably know this, but there are more millionaires and billionaires made during a downturn and a market recession and repricing than when times are very, very good. CRE is a standstill. Literally, assets are not trading. There's a big spread between bid and ask. If you're a seller, you want price A. If I'm a buyer, I want price Z. And that spread's not compressing anytime soon. Look, as it relates to commercial real estate, the reality is when interest rates go up, cap rates must go up as well. Otherwise, you have what's known as negative leverage. There's got to be a spread above interest rates so that there's positive yield on an investment. And a lot of sellers are simply not willing to recognize that repricing of assets. And that will take quite some time to resolve itself. It's not something, because it's a very illiquid asset class, it's not something that's going to happen overnight. It will take literally 3 to 4 years before we find a bottom. But in the meantime, look, I'm telling you, we're starting to see some incredible deals out there. We're starting to see the beginning of massive layoffs. And you've all heard the story at Twitter. 75% is what Elon Musk was saying. I don't think he intends to execute on that, but there's currently a hiring freeze. We're starting to see larger corporations lay off some of their employees. A lot of it has to do with, look, there's a lot of corporations out there that are publicly traded that are losing money. And I mean, huge money, billions of dollars a year. It's not likely they're going to be able to raise capital through sale of stocks as they have historically done. So they need to tighten their belts and try and tighten their belts dramatically. So the other thing is the Federal Reserve is going to continue to raise rates in the face of recession. That is mind-boggling to me. They'll stay the course on rate increases until they see a material shift in inflation. But remember, inflation is a lagging indicator. It's not a leading indicator. So we're going to overdo it, or I should say the Federal Reserve is going to overdo it, as they always do. He, in particular, has been yeah, I think I made my point relative to Jay Powell. He should be fired. He should be taken out to the woodshed. He's created an economy that well, we didn't need to suffer these consequences. Yes, we needed to act as a result of the pandemic, but frankly, the economy, price stability, employment, currency stability, all are secondary priorities for him, which they should not be. And look, I guess that I'm at the point where I'm just preparing for significant distress in the marketplace. When things get bad is when I get really busy. One of the things that we do at Performance Advisory Group is we work with buyers who are or owners, investors, and managers that own commercial real estate and other assets that are in distress. Oftentimes during economic downturns, that distress is triggered as a result of the debt. So we go in and modify and or restructure debt such that it's sustainable in the business or the real estate can afford it. I personally have done more than $11 billion in transactions over the course of my career. And I look forward to doing a lot more over the next couple of years. Look, we're in the service business. We're here to serve you, our client. And I don't know, I'm not good at a lot of things, quite frankly, including these presentations, but I do it because I want to be a public service, and I do it because there's a lot of people out there that are struggling, and I want to be the guy who helps solve the problem rather than creates the problem. And one of the ways I do that is by opening people's eyes and getting them to understand the core underlying pillars of our economy and what's going on. A lot of people weren't aware of the M1 increase. It's a primary driver behind what's going on today. So look, challenges, everybody's got them. To what degree is, it's personal. It's dependent upon who you are and what your situation is, obviously. But I'm available to you. This is how do you get a hold of me? If you're watching this on YouTube, I'll leave my links down in the description. There's my phone number. It's a direct number. Call me anytime. I'm here for you. God bless you. I hope you found this valuable. And have a lovely day.